Good afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, March the 31st, and wanted to just take a second to talk about what we saw in equity markets last week, what we are continuing to see internally with market internals, and talk a little bit about the 2 and 10-year yield curve that almost inverted this week and what that means and a more accurate representation of studying the yield curve when looking at economic conditions. Last week was another great strong up week in the S&P 500. The S&P 500 finished the week up 1.7%, which is an incredible move this month from the March lows. To put things into perspective, at the March lows, we were down about 11.8% on the S&P 500. And where we sit currently, as of today, at the end of the quarter on the 31st, we're only down a little bit over 3% year to date. So we've really rallied 8% this month off of the lows that we saw this month. Another strong week in the S&P 400, with the S&P 400 finishing the week up 20 basis points or 0.2%. And the small cap index, as measured by the S&P 600, was actually off 50 basis points for the week, or down 0.5%. So what we saw last week was another continued rally and push, and we just talked about how great of momentum we've seen. And typically when we see a retracement this strong from the lows that we've seen so far year to date, we don't go back down and retest those lows. So we've reestablished another low. If you're a chartist or a technical analyst who likes to look at the technical side of the stock market, once we have a retracement off of these lows, we typically don't see go back down to those lows. It's never happened in the history of the stock market. So we see the market moving forward, which is a very strong sign. But then this week we got kind of a warning sign for the stock market when the 2 and 10-year yield curve almost inverted. And what that means is when the yield of the 2-year Treasury note exceeds the 2-year Treasury bill exceeds the 10-year Treasury note, and the yield is actually higher on the 2-year than the 10. And what that can indicate is that a recession is on the horizon in 18 to 24 months. Now, this is a pretty accurate representation. It's right about 80% of the time. It's not always correct when the 2 and 10 invert. They are not always 100% right on a recession coming. So I wanted to talk about what's kind of causing that and a more accurate representation of what you as an investor should be looking at on the yield curve perspective. And then I want to talk a little bit about some continued strength on the market internals. So the 2 and 10-year got 1 basis point or 0.01% away from inverting this week. Now, one of the things that is causing this is you have the Federal Reserve that is raising rates on the short end while still buying the 10-year Treasury on the back end. And what that does is they're buying the 10-year is it pulls the yield down. So the Fed has not started their full-on tapering yet. And what I mean by that is they're still buying 10-year Treasuries, so they're actually keeping the yield depressed. So if we were in regular market conditions without Fed support, you would see a 10-year Treasury much higher than what you're seeing in current conditions. So that is one of the reasons why the curve is getting flattened, is because the Fed is keeping the 10-year down and short-term rates are rising as the Fed is increasing short-term rates. But a more accurate representation, and has called it every single time there's been a recession, is when the 3-month Treasury inverts with the 10-year Treasury. And we are nowhere close to that. The 10-year Treasury right now is hovering in the 2.3% range, up or down about 10 basis points. And the 3-month Treasury is around 60 basis points. So a huge spread between the two. So we have very, very strong economic conditions. And at River Place, we understand that as the Fed is raising interest rates, that of course there is the fear of recession on if the Fed overdoes it. But right now what we're seeing in the market and market internals is not indicating that we are there yet. So we're continuing to monitor that and how to navigate through that. The other encouraging thing that we're seeing in the market is the money flows are really starting to turn positive, and we've seen a huge thrust in momentum and positive money flows. And that is a great indication that there's more buying than selling going on in the market, and the buyers have come back in to support this market. So if you're in the market, be glad that the buyers are back and pushing things forward. We continue to believe that we're going to have positive returns this year. They're not going to be as glamorous as we've seen in the last 3 years, we don't believe. But we believe that we're going to continue to march towards positive returns this year. So as always, if you have questions about what's going on in your individual portfolio or what the yield curve inverting and how that works and the functionality of that, call us. We're easy to talk to. You can reach us at 904-346-3460, or as always, check us out online at www.riverplacecapital.com. I hope everybody has a wonderful rest of your week. Thanks so much.